You ever look at your retirement account and just feel lost? Like you've been putting money in for years, maybe decades, and you've got all these investments with confusing names. And you're just sitting there thinking, is this even working? Am I doing this right? And the worst part is every year they're taking fees out of your account, and you don't even know if you're making money or if those fees are just eating it all up. That feeling of not knowing if your money's actually growing or just sitting there shrinking, that's what keeps people up at night when they're 50, 55, 60, looking at retirement and wondering if they saved enough. My name is Richard, and I teach what schools should have taught us about money. I do obsessive research on financial psychology and why some people build wealth effortlessly while others stay stuck for decades, even when they're doing everything they're told to do. Make sure you smash that like button and hit subscribe if this video helps you view money differently. Now, before we get into the topic, let me paint you another picture. You're sitting at your kitchen table on a Sunday afternoon, and you've got statements from 3 different retirement accounts spread out in front of you. There's the 401k from your current job, the old retirement account you moved from your last job, and maybe another investment account you opened 5 years ago because someone told you it was smart to spread your money around. You're looking at all these fund names, all these numbers, and you're trying to figure out what you actually own. And the truth is, you can't. You've got 12 different investments, and you have no idea if you actually own different things or if you're just paying fees on the same companies 12 different times. And that confusion, that's costing you money. Because while you're trying to figure it out, those fees are quietly taking chunks out of your retirement every single year. But here's where things get interesting. The US stock market has made about 10% per year on average for the past 30 years. That's through crashes, recessions, pandemics, everything. But most people over 50 don't see anywhere close to that. And it's not because they picked bad investments or got the timing wrong. It's because their money is split up between too many different funds, they're paying too much in fees, and they're so confused by all of it that they just give up. They stop looking at it, they stop making changes, they just cross their fingers and hope it works out. And that's the problem I want to fix today, because there's a way simpler way to do this that actually works better. Let me start with the fee problem, because this is where most people are losing money without even realizing it. Traditional mutual funds, the kind that have been around forever and that most workplace retirement plans offer, they charge you fees every year just for owning them, usually somewhere between 0.5% and a full percent of whatever you have invested. Now, that doesn't sound like much, right? 0.5%, 1% seems like basically nothing. But let me show you what that actually means. If you've got $500,000 saved up and they're charging you 0.75% in fees, that's $3,750 coming out of your account every single year. Every year. That money disappears whether your investments go up, go down, or stay flat. Now compare that to ETFs, which stands for exchange traded funds. These are newer types of investments that own the exact same stuff as those old mutual funds, but they charge way less. We're talking 0.03% to 0.06% per year. So on that same $500,000, you'd only be paying $150 to $300 per year instead of $3,750. The difference is about $3,500 every single year. And here's the part that really stings. Over a 20-year retirement, that's more than $70,000 you're saving just by switching to the cheaper version of the same thing. And that's not even counting what that extra money would have grown into if you'd kept it invested instead of handing it over in fees. So the first problem most people over 50 have is they're paying way too much for something they could get for way less. The second problem is you're buying the same thing over and over without knowing it. And this one's sneaky because most people have no clue it's even happening. You own 12 different funds and you think you're spread out across different investments. But when you actually look inside those funds to see what companies they own, you find out that 8 of those 12 funds all own the same big companies. Apple, Microsoft, Amazon, Google, they're in almost everything. So you're not really spread out at all. You're just paying fees on 12 different funds that are all buying you the same stocks. It's like paying for 12 different pizzas when they all came from the same Pizza Hut. You've got the variety of maybe 3 funds, but you're paying for 12. And the third problem is you just freeze up because it's all so confusing. When you've got 15 different investments and you don't really understand what any of them do, you stop making decisions. You stop checking if things need to change. You stop adjusting as you get closer to retirement. You just let it sit there and hope for the best because trying to figure out what to do feels like too much. And that's how people end up with investment accounts that made sense when they were 35, but make zero sense when they're 62 and about to stop working. So here's what I want to show you today. You can build a complete retirement plan with just two funds, not 10, not 15, two. One fund makes your money grow. The other fund pays you cash every few months. Together, they cover everything you need. Money that grows faster than prices go up, and actual cash coming in that you can spend without having to sell anything at the wrong time. And the total cost? About $50 per year if you've got $100,000 saved. Let me break down exactly how this works. The first fund is called VTI, which stands for Vanguard Total Stock Market ETF. And here's what makes it so powerful. It owns a piece of basically every company in America. Not just the big companies, not just tech companies, not just one type of business. Everything. About 3,600 different companies across every industry you can think of. If it's a company that's traded in the US, VTI owns a piece of it. So when you buy one share of VTI, you instantly own a tiny slice of the entire American economy. If American businesses do well, your investment does well. Now here's why that matters. Over the past 30 years, the US stock market has made about 10% per year on average. That includes the dot-com crash in the early 2000s, the housing crash in 2008, and the COVID pandemic in 2020. Through all of that chaos, the long-term average is still about 10% per year, and VTI gives you that same 10% because it owns the whole market. It's not trying to guess which companies will win. It just owns all of them and lets the economy do its thing. And the cost? VTI only charges you $3 per year for every $10,000 you have invested. Compare that to an old school mutual fund charging $75 per year on that same $10,000, and you're saving $72 every single year. VTI also pays you a little bit of cash every few months, about 1.3% to 1.5% per year. That's not a lot of income, and that's okay, because the main job of VTI is to make your money grow. It's there to make sure your savings grow faster than prices go up over the long run. Let me give you a real example of what that looks like. Let's say you're 52 years old today, and you've got 13 years until you retire at 65. You take $100,000 and put it into VTI, and you keep adding $500 every month going forward. If VTI does what it's done historically, about 10% per year, by the time you're 65, you've got about $370,000. Your starting $100,000 grows to about $342,000 just from sitting there and growing. Your monthly $500 payments, which add up to $78,000 over 13 years, turn into another $120,000 in growth. So your money isn't just sitting there, it's growing faster than prices go up, which is about 2.5% per year on average. And here's why that growth matters so much. If you retire at 65 with $500,000 and you don't grow it at all, you just leave it in a savings account earning basically nothing. By the time you're 93, that money only buys half as much as it does today. Inflation cuts your buying power in half over 28 years. So if you think you're playing it safe by avoiding the stock market, you're actually taking a different kind of risk. The risk that your money won't last because it can't keep up with rising prices. That's why VTI is in the mix. It fights against rising prices. It's what keeps your money growing even after you stop working. But just making your money grow doesn't solve the whole problem. And this is where most people get stuck. Because when you're working, you don't need your investments to pay you. Your paycheck covers your bills. But when you retire, that paycheck stops, and now your investments have to replace it. And if all you've got is VTI, you're forced to sell pieces of it to get cash. And that's fine when the market's doing well, but imagine the market crashes 30% right after you retire. Now you're selling pieces at really low prices, locking in losses You'll never get back. That's called sequence of returns risk, and it's one of the biggest dangers when you retire. So you need a second fund that pays you cash without you having to sell anything. And that's where SCHD comes in. SCHD stands for Schwab US Dividend Equity ETF, and it owns about 100 solid American companies that pay their shareholders cash regularly. These aren't just any companies. To get into SCHD, a company has to have paid cash to shareholders for at least 10 years straight, have low debt, and make real profits. The fund isn't going after sketchy companies that pay high amounts but might go broke. It's focused on stable companies that can keep paying you cash year after year. SCHD currently pays about 3.3% to 3.6% per year, and that cash hits your account every 3 months. So if you've got $250,000 in SCHD, you're getting about $8,750 per year in cash payments. That's roughly $729 per month, but it comes in 4 chunks throughout the year. If you've got $500,000 in SCHD, you're looking at about $17,500 per year, or $1,458 per month. And here's the key. This is real cash landing in your account. You don't have to sell anything. You don't have to guess when the market's high or low. The money just shows up 4 times per year, whether the stock market is doing great, doing terrible, or going nowhere. But here's what makes SCHD really powerful. And this is the part most people don't think about. Those cash payments go up over time. Over the past 5 years, SCHD's cash payments have grown somewhere between 6% and 13% per year on average. So let's say you put $250,000 in SCHD today, and you're getting $8,750 per year in cash. If those payments grow by 8% per year, which is in the middle of what it's done before, by year 10, you're getting $17,150 per year. By year 15, you're getting $25,250 per year. Your cash payments more than double in 10 years and almost triple in 15 years, all from the same money you put in at the start. You didn't add more. The payments just kept getting bigger. Compare that to a high-yield savings account. Right now, some of those accounts are paying 4.5%, which sounds pretty good. But when the Federal Reserve cuts interest rates, that number drops. In a few years, that same savings account might only be paying 2% or even less. SCHD's cash payments, on the other hand, keep going up over time. When the Fed cuts rates, that doesn't change the fact that you own pieces of 100 profitable companies that keep paying you cash every 3 months. And that's why getting paid by companies tends to be more reliable over the long run than just keeping money in savings or bonds. Here's something else most people don't realize. Stocks that pay you cash regularly actually drop less during market crashes. During the 2008 financial crisis, the overall stock market dropped about 37%, but funds focused on companies that pay cash regularly only dropped around 25% to 30% because those companies were more stable. They made real profits, didn't have much debt, and had solid businesses. So you're not giving up safety to get income. You're actually getting both, more income than savings or bonds and less ups and downs than the overall stock market. Now, here's the question everyone asks at this point. How much of each fund should I own? And the answer depends on one thing: how soon you need the cash coming in. I'm going to give you 3 simple splits, and you just pick the one that matches where you're at. There's no complicated math here. You're just deciding how much you need your money to grow versus how much you need cash coming in right now. The first split is what I call safety first, and it's 30% VTI, 70% SCHD. This is for people who are 62 to 67 years old and stopping work in the next 2 to 5 years, or people who've already stopped working. You're making cash the priority because you need it now, and you're lowering how much the market swings affect you because you don't have time to wait out a big crash. So let's say you've got $400,000 saved. You'd put $120,000 into VTI and $280,000 into SCHD. At about 3.5% cash payments, that SCHD chunk is giving you about $9,800 per year, which is roughly $817 per month. That's money you can spend without selling anything. Meanwhile, your VTI chunk is still growing. Even if it only grows at 7% per year, less than the long-term average, that $120,000 turns into about $188,000 in 10 years. So you've got cash coming in today and growth to keep up with rising prices for the next 20 or 30 years. The second split is balanced, and it's 50% VTI, 50% SCHD. This is for people aged 55 to 62 who are stopping work in 5 to 10 years. You want half focused on growth and half focused on cash coming in because you're still building up your savings, but you're also starting to think about needing that cash soon. So if you've got $300,000, you'd split it right down the middle, $150,000 in VTI and $150,000 in SCHD. Your SCHD half gives you about $5,250 per year in cash. If you're still working, you can take that cash and buy more shares to grow it even faster. If you've already stopped working early, you've got $437 per month coming in, and you can sell small bits of VTI when you need extra money. This split is right in the middle. Not too risky, not too safe. The third split is growth focused, and it's 60% to 70% VTI, 30% to 40% SCHD. This is for people aged 50 to 55, with at least 10 to 15 years before they stop working. You've still got plenty of time to wait out the market's ups and downs, so you're going heavy on growth. Let's say you've got $200,000 and you do a 70-30 split. $140,000 in VTI, $60,000 in SCHD. Your SCHD chunk gives you about $2,100 per year in cash, which you use to buy more shares. Your VTI chunk has 10 to 15 years to grow. If it grows at 10% per year, that $140,000 turns into about $363,000 in 10 years without you adding a single extra dollar. Here's the rule for changing this over time, and it's really simple. You start with one of these three splits based on how old you are today. Then every 2 to 3 years, you move 10% from Chuck or VTI over to SCHD as you get closer to stopping work. So if you start at age 50 with a 70-30 split, by age 56, you're at 60-40. By age 62, you're at 50-50. And by age 65, you're at 30/70. You naturally move toward more cash coming in without having to make complicated choices every year. It's just a slow shift that matches what you need as you get older. Now, I need to talk about the 3 risks you have to manage, because no investment is perfect. The first risk is market crashes happening at the worst possible time. I could drop 30% to 50% during a bad recession. That's not me guessing. It's happened before. The stock market dropped 37% in 2008 and 34% during COVID in 2020. If that crash happens right when you stop working and you need to start taking money out, you're forced to sell pieces at really low prices and lock in losses you'll never get back. That timing problem, where the market crashes right when you need the money, is what we're trying to avoid. And here's how you protect yourself. You keep 2 to 3 years of living expenses sitting in cash or a savings account as a safety cushion. So if you need $40,000 per year from your investments, you keep $80,000 to $120,000 in a high-yield savings account or money market fund that you can touch immediately. During market crashes, you pull from that cash pile instead of selling VTI or SCHD when they're way down. During good years when your investments are up, you refill that cash pile by selling small amounts when prices are high. This simple trick fixes the timing problem for most people because your investments have time to bounce back before you need to touch them. The second risk is companies cutting the cash payments during tough economic times. Even though SCHD owns 100 solid companies, those cash payments can still drop during really bad recessions. In 2020, a lot of companies cut or stopped their cash payments for a while. SCHDs spread across 100 companies helped, but the fund's total cash payment per share did dip a little bit. Here's the fix. Don't build a spending plan that needs every single dollar of those cash payments. Leave yourself a 10% to 15% cushion. If SCHD is giving you $10,000 per year, only plan to spend $8,500 or $9,000. That cushion absorbs temporary cuts without forcing you to sell shares when you don't want to. The third risk is taxes if you're switching out of your old funds. If you have mutual funds sitting in a regular investment account, not a retirement account, and you sell them to buy VTI and SCHD, you'll owe taxes on any profit you made. That could be a big tax bill depending on how much those funds went up since you bought them. Here's the smart way to do it. Start with your IRAs and 401s, Ks first. In those retirement accounts, you can sell everything and buy VTI and SCHD without paying a single dollar in taxes because those accounts are tax protected. Handle those first. For regular investment accounts where taxes do matter, go slow. Sell small chunks each year to keep your taxes low. Or if some of your investments are actually down, sell those first because you won't owe taxes on losses. Here's what I want you to do this week. Open up your investment accounts and look at what you actually own. Count how many different funds or stocks you've got across all your accounts. Then figure out what you're paying in fees. Look up the fee percentage for each fund and add them all up based on how much you have in each one. Compare that total to the 0.03% to 0.06% you'd pay with VTI and SCHD. If the difference is big, and for most people it will be, start planning to make the switch. Start with your IRAs and 401ks where you can move money around without tax problems. Then pick one of the three splits based on where you're at. Use 30-70 if you're stopping work soon, 50-50 if you're in the middle, or 60-40 to 70-30 if you're 10 plus years out. VTI has made about 10% per year over the long run. SCHD pays about 3.5% in cash right now, and those cash payments have been growing 6% to 13% every year. Together, they give you growth in cash coming in, with total costs under $50 per year if you've got $100,000 saved. Let me know what you guys think about this video.